The US has gone through some tough times this year, especially with a presidential election in the middle of a pandemic. But with a new president coming to office this year, there might be a few changes on how we manage our finances, especially our taxes. President-elect Joe Biden says that he intends to make changes to the current tax plan placed by President Trump back in 2017. But what are these changes and how will they affect your pocket? Well, in today's episode of the Betterment Project, we're going over key points in Joe Biden's new tax plan to understand not only how it affects you as an individual, but also how it affects you as an entrepreneur. If you like financial videos like this, make sure to subscribe and hit the bell button to be notified when we upload a new video. And let's get started. As most of us know, in 2017, President Trump passed a new law that cut taxes across the board. Corporate taxes, which stood at 35%, were lowered to 21%, which has been the biggest corporate tax cut in recent history. Individual taxes were also cut. The highest tax bracket of 39.6% went down to 37%. The 33% tax bracket went down to 31%. The 28% bracket went down to 24%. The 25% went down to 22%. And the 15% tax bracket went down to 12%. Now, these changes were temporary and were set to expire in 2025. So let's get started with the new Joe Biden tax plan, starting with how it would affect the individual person. First, Biden is looking to revert the top tax bracket back to 39.6% from the current 37%. This seems to affect only the top bracket earners and not the lower brackets. This means that people earning a high income will pay 2.6% more in their federal taxes on income over $523,000. This change only reverts the top tax bracket as it was before 2017. But this new tax plan would also increase the tax paid by those with an income over $400,000 by reapplying the Social Security tax. As the tax code is written now, someone earning money would have to pay 12.4% in Social Security tax on the money they earn up to $142,000. This means that this tax no longer applies to any money that is earned over $142,000. So if anyone is making $1 million per year, only $142,000 of those dollars are subject to Social Security tax. The rest of the money is not. This tax is also split between an employer and an employee. This means that the employer will pay 6.2% of this tax as payroll tax and the employee will pay the other 6.2% as Social Security tax. But when someone is self-employed, they act as both the employer and the employee and are responsible for paying the full 12.4% tax. With this new tax plan, this tax will stop at $142,000 and reapply on any income over $400,000. This creates a small gap of income where this tax will not be applied. Income between $142,000 and $400,000 will not be subject to this tax. There are two main groups that will be affected by this tax. First, high-paid professionals like doctors, surgeons, attorneys, artists, professional athletes, or high-paid executives. Basically, anyone who makes over $400,000 per year from a job. The second group will be companies who employ these high-paid professionals, since they will have to pay half of this tax for each employee on income over $400,000 a year. Most entrepreneurs who are self-employed and make over $400,000 a year can be affected by this tax since they would normally have to pay the full 12.4%. But many entrepreneurs who are running their business can avoid this tax by running their business as a corporation. If their business begins making over $400,000 per year, they can begin running their business as a corporation and pay the majority of their income as dividend distributions. Since this is a different type of income, dividends are not subject to Social Security or Medicare tax, helping the entrepreneur avoid this tax altogether. For example, let's say that our friend Tom here has a business and is making $1 million per year in profits. If he ran his business as a single member LLC, like if he was self-employed, he would have to pay over $92,000 in Social Security taxes alone with this new tax plan. But if he decides to run his business as an S corporation and pay himself a modest salary of $50,000 per year and pay himself the rest of his profits in dividend distributions, he would only have to pay $6,200 in Medicare taxes instead of $92,000, since only his salary is subject to the Medicare tax. Although he can avoid paying for this Medicare tax, he is not out of the waters just yet. Biden's new plan also is looking to increase the corporate tax from 21% to 28%. This means that even if our friend Tom goes corporate to avoid this tax, he would still be paying a higher tax on his corporate tax bill. Not mentioning that he is now subject to double taxation, since he would have to pay corporate taxes on his business profits and dividend distribution tax on anything he pays himself. This corporate tax is an increase from Trump's plan, but still lower than it was before 2017. Before 2017, corporations had to pay 35% in corporate taxes. It is unknown how corporations will react to this tax increase, since this is still a tax cut from pre-2017, but still an increase from Trump's tax reform. Before, the higher tax led many corporations to look for ways to lower their tax bill. For example, many people have seen those reports of companies like Amazon not having to pay any money for federal taxes on their profits. One of the reasons for that is because many startups run their companies at a loss for a few years as they're growing their business. This means that for a few years, these companies are not making any money. In fact, they are losing money. With the current system, a company can roll over their losses to offset their profits when they finally become profitable. For example, if a company lost $1 billion in the first 5 years, and in their 6th year they made $1 billion in profits, the losses from the previous years can be rolled over to cover the profits of the current year, giving them a net taxable income of $0, allowing them to avoid paying taxes on those profits. With Biden's new plan, he is proposing that any company who makes $100 million or more in profits will have to pay a minimum of 15% corporate tax regardless of their rollover losses. This means that our billion-dollar company would not have to pay the corporate tax of 28% due to rollover losses, but would also no longer be allowed to pay $0 in corporate taxes. Rollover losses would only lower their tax rate to a minimum of 15% on the money they make over $100 million. Now, the next proposal might have a big effect on investors. The new tax plan is proposing to tax capital gains and qualified dividends as earned income on anyone with an income over $1 million. The current law taxes short-term capital gains, or profits from an asset sold within a year, as regular income, and long-term capital gains, or profits from an asset sold after 1 year, at a max rate of 20%, and an additional 3.8% on income over $200,000 for a single individual. For example, if you sold an asset for $1 million in profit after 1 year of holding it, you would have to pay $200,000 for the long-term capital gains and an additional $30,400 for the net investment income tax. This means that you would have to pay a total of $230,000 in total tax. With the new plan, the long-term capital gains would be treated as regular income at a marginal rate of 39.6% plus the 3.8% net income tax on anything over $200,000. This means that after the sale of this $1 million asset, we would have to pay over $346,000 for the marginal rate for the 39.6% tax bracket and an additional $30,400 for the net income tax on anything over $200,000. This brings a total tax of $377,348, which is an effective tax rate of 37.7% for federal taxes alone. This does not include state taxes, which can take our tax liability to near 50% depending on the state. This can have a massive effect on high net worth investors with multi-million-dollar holdings. But when there's a will and millions of dollars at stake, there's a way. There are a few strategies that many investors can use to avoid being taxed in the first place. To avoid taxes, investors can simply not sell their assets. If money is needed, for example, to start a business or invest in other assets, they can simply go to a financial institution, borrow money, and put their assets as collateral and spend the borrowed money. Since borrowed money is debt, not income, it cannot be taxed. This way, they can continue investing and pay off their debt with their profits, or they can conveniently forget to pay their debt and have the financial institution take their assets they wanted to sell in the first place. They are able to get money from their assets without paying taxes for it. Even if the loan charges interest, it is better to pay a 3 or 4% interest rate on borrowed money than a 50% tax. This becomes more difficult if an investor or company owner has dividend income over $1 million per year. This type of income is currently taxed at a max rate of 20%, but with the new tax plan, this would also be treated as regular income on anything over $1 million. This can cause business owners, especially those earning just above the $1 million mark, to either reinvest back in the business and pay themselves just under $1 million, or use their corporations to purchase many of the things they would with post-tax money. For example, a company owner can use his corporation to buy real estate properties, for example, that the owner could use, or transportation like a nice car that the owner can drive. This can be done under company expense, which can still allow them to live under their lifestyle without needing to pay themselves first, avoiding paying taxes on this money altogether since many company expenses can be deducted from their taxable income of the company, allowing them to use these expenses to lower their tax bill. There are a few benefits for individuals to take advantage of the new tax plan. This plan proposes to re-establish first-time homebuyers' refundable credit of $15,000 for first-time homebuyers. This means that this credit can save first-time homebuyers $15,000 on their first home's down payment. Also, the new plan states that as economic conditions require, the child tax credit would increase from the current $2,000 per child to $3,000 per child under 17 and an additional $600 per child under 6 years old. And this credit will be fully refundable, meaning even if you don't have a tax bill, you will still receive a check for this credit. Now, this new plan is a proposal that hasn't gone into effect, and we don't know if all the changes will be applied or the effect it will have in the economy overall. Let me know what you think about this new tax plan. Do you agree with the changes or disagree with them? Let me know in the comments below. See, we all know that 2020 was a tough year for everyone, but this shouldn't discourage us from making 2021 our best year yet. And to help you prepare for this year, I've partnered with Blinkist as the sponsor of this video. Blinkist allows you to get the main concepts of a book in 20 minutes or less. They gather the main concepts from over 3,000 non-fiction bestsellers in over 27 categories and gather them in easy-to-consume reads. Now, the best part is that you can read it if you're more of a reader, but they also have audio explainers that help you understand more about the core ideas. And since it's in your phone, you can take it anywhere. You can consume a book on your way to work or while working out at the gym. And even if you're flying, because you can download and listen offline. See, over 14 million people are using Blinkist already to grow their knowledge on finances, business, leadership, self-improvement, mindfulness, happiness, and much, much more. The reason why I personally like Blinkist is because it's so simple to use. All you have to do is open the app, search for the book you want, and that's it. You'll be reading or listening in less than 20 seconds. And now, Blinkist has teamed up with popular podcasts to blink those too, so you can get the main ideas of a podcast even faster. Listen, if you want to expand your knowledge and make sure your time is well spent, then Blinkist is the place to go. And I was able to get 100 of you guys a whole week of Blinkist absolutely free when you click in the link in the description of this video. You can try it out and cancel if you want, but if you decide to keep learning with Blinkist, you'll get an additional 25% off your full membership on top of the free week. So to claim your unlimited free 7-day access, make sure to click in the link in the description of this video and start leveling up your knowledge. If you enjoyed this video, make sure to hit the like button to tell YouTube to continue sharing our content and making financial information the norm. And as always, thank you for watching, and I will see you in the next video.